Welcome to PanEuro Special Situations Group.
Europe is facing a severe investment deficit. To execute the climate transition, scale digital infrastructure, and rebuild continental defense capabilities by 2030, the European Union must mobilize private capital at a volume it has never previously achieved. This dashboard tracks the specific target metric identified by the Draghi and Letta reports. The European economy requires an additional 750 to 800 billion euros of investment every single year through the end of the decade to meet its strategic mandates. Financing that gap depends on three massive regulatory frameworks that are all moving toward a 2029 finalization date: the Basel III capital requirements for megabanks, the Savings and Investments Union, and the rollout of the digital euro. Evaluated in isolation, each of these frameworks operates on sound logic, but European financial architecture does not operate in isolation. Modeled together, the non-linear interactions between these three policies place them on a structural collision course. Managing these interconnected policy vectors in isolated silos creates the conditions for a systemic credit contraction. If these frameworks remain uncoordinated, they threaten the viability of the entire 800 billion euro mandate. To understand this design flaw, we must run a reverse stress test on the EU banking system, targeting the 2029 convergence date. The tail risk outcome in this scenario is a complete freeze of credit supply from EU megabanks. This happens at the exact moment the Savings and Investments Union requires maximum market liquidity to fund European infrastructure. The objective of this analysis is to deconstruct the specific balance sheet mechanics and transmission pathways that elevate this failure from a theoretical tail risk into a serious probability. Evaluating these intersecting risks requires abandoning the single-issue lobbying that dominates European policy debates. We have to treat the EU financial architecture as a single, dynamic system. The dominant narrative from the banking industry is that European megabanks are uncompetitive globally because they carry a crushing, absolute capital requirement burden compared to their American peers. Standardized risk-adjusted capital ratios contradict the industry's narrative. EU megabanks average a 9.9% ratio, trailing US peers at 10.28%. Historical EU internal models masked this with lower risk weights. Under strict US rules, EU banks would face a 17.5% capital increase. The transatlantic divergence is growing sharper. While the US pursues an aggressive deregulatory trajectory to lower capital constraints, the EU is strictly phasing in the Basel output floor through a rigid compliance schedule running to 2033. The competitive disadvantage for European banks is a direct consequence of the structural complexity of capital governance. The actual constraint crippling EU megabanks is macroprudential fragmentation. Across the Eurozone, cross-border banks navigate 86 overlapping buffer requirements administered by 21 national authorities. This fragmented architecture creates trapped capital. Ring-fencing forces banks to legally strand capital within national subsidiaries, blocking them from moving funds across borders to where they are needed most. This severe fragmentation is lethal to the Savings and Investments Union. The entire premise of the SIU requires seamless cross-border capital deployment to finance continental-scale projects. This 86-layer buffer salad acts as a massive structural tax on capital efficiency. It completely immobilizes core equity and severely limits the cross-border credit intermediation that Europe's strategic goals depend on. The digital euro introduces the next compounding stress factor. The European Central Bank designed a two-tiered distribution model. The central bank issues the currency, but its distribution relies entirely on commercial bank infrastructure. Under maximum adoption models, up to 650 billion euros flow out of stable retail deposits as citizens convert to digital euros. Banks must replace this with central bank refinancing, triggering a severe funding downgrade. This liquidity sensitivity immediately forces supervisors to increase Pillar 2 capital requirements. Simultaneously, banks must build the technology to distribute these digital wallets, costing up to 5.8 billion euros. Under Basel III rules, these investments are classified as intangible IT assets, meaning the entire cost is fully deducted directly from the bank's core Tier 1 capital. The digital euro effectively acts as a stealth capital charge. It degrades regulatory liquidity ratios on the liability side, while directly depleting core Tier 1 capital on the asset side. These cascading balance sheet mechanics trigger a massive, dynamic, and self-reinforcing feedback loop across the entire European banking system. In this causal loop, digital euro outflows compress net interest income by up to 18 basis points, causing a projected 13% drop in return on equity. This suppressed return starves banks of retained earnings, right as rigid CRR3 rules demand higher capital floors. The institutional reaction to this squeeze is entirely rational. Capital-constrained banks will restrict lending, maximize fee extraction on payments, and lobby to cripple its utility. When severe capital constraints trigger this reverse causation loop, the massive policy frameworks actively grind against and neutralize each other. This dynamic places the €800 billion mandate in serious jeopardy. Averting this stress scenario requires a grand strategic bargain centered on structural reengineering. Simplifying the capital stack without reducing safety capital is the first pillar. Shifting authority to the single supervisor mechanism collapses 86 overlapping buffers into 3 transparent layers. This frees €281 billion of immobilized Tier 1 capital, unlocking €2.8 trillion in lending capacity. The second pillar requires eliminating home host capital ring fencing entirely, forcing the completion of the long-stalled banking union. Liberating that trapped capital makes cross-border mergers commercially rational again. It is the only mechanism capable of catalyzing the pan-European bank consolidation that the Savings and Investments Union structurally requires to function. Deep structural simplification is the only mechanism capable of fully funding Europe's transition goals without compromising systemic safety. The third pillar requires calibrating the digital euro to achieve its goal of monetary sovereignty without triggering the destructive margin compression feedback loop. This wallet interface illustrates the necessary mechanical limit. Capping initial holdings firmly between €500 and €1,000 arrests the deposit drain, ensuring the payment utility of the instrument while insulating bank balance sheets from systemic refinancing shocks. Concurrently, regulators must formally integrate digital euro run risk into the annual stress testing architecture, closing the supervisory blind spot well before the 2029 issuance. The legislative window to enact these 3 pillars is rapidly closing. The critical decisions on the Bank Competitiveness Report and the Digital Euro Trilogues are concentrated in the second half of 2026, setting the trajectory for the final spring 2029 target. For capital markets practitioners and institutional planners, mapping firm exposure against this tripartite collision is the defining strategic task. Models that treat these policies as separate tracks will systematically misprice the risk. Systemic resilience, capital market depth, and monetary sovereignty are structurally interdependent. European competitiveness now demands integrating all 3 by 2029.